Welcome to TOITOI Japan Market Radio, Monday, March 23, 2026. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japanese markets, covering equities, currencies, rates, and the stories moving capital flows in and out of Japan. Today we're joined by our portfolio manager who focuses on Japanese macro. Let's start with the market snapshot.
Thanks for having me. Well, we don't have complete market data available for today's session, so we're unable to provide the usual Nikkei 225, TOPIX, or USD, JPY figures at this moment. That said, we do have some significant news flow that's shaping sentiment around Japanese assets, particularly related to global risk appetite and commodity markets. So even without the headline numbers, there's plenty to discuss in terms of drivers and positioning.
Understood. Let's dive straight into the news then. The first story we're watching closely is around copper prices. Bloomberg is reporting that copper has fallen to a 3-month low amid rising concerns about global economic growth. This is a pretty significant move. Walk us through why this matters for Japan specifically.
Absolutely. Copper is often called Dr. Copper because it's seen as a diagnostic tool for global growth. When copper prices fall like this, it's signaling that investors are worried about demand destruction in manufacturing, construction, and industrial activity worldwide. For Japan, this is particularly important because the country is a major net importer of copper and the metal is critical for 3 pillar industries: electronics manufacturing, automotive production, and construction. So falling copper prices are really a double signal. First, they indicate weakening global demand, which threatens Japan's export-dependent economy. Second, they can contribute to broader commodity deflation, which makes it even harder for the Bank of Japan to achieve its inflation targets.
Right, so this isn't just about the metal itself, it's about what it tells us about the global economic backdrop that Japan relies on. How do you see this playing out across Japanese asset classes?
Let's start with equities. Weakness in copper is generally a downside risk for the Nikkei and TOPIX. Cyclical exporters are going to feel the pressure, particularly trading houses like Mitsubishi Corporation and Mitsui, which have significant exposure to commodity markets. Electronics and auto manufacturers are also vulnerable because weaker copper signals softer end demand for their products globally. On the yen side, we'd actually expect some strengthening. This kind of risk-off environment typically drives safe haven flows into the Japanese yen. Lower commodity prices also weigh on commodity-linked currencies like the Aussie dollar, which indirectly supports the yen. And for Japanese government bonds, this should be supportive. Growth concerns increase demand for JGBs as a safe asset, pushing yields lower and potentially flattening the curve.
So in a risk-off scenario driven by growth fears, we could see Japanese equities under pressure, the yen appreciating, and yields grinding lower. That's a fairly classic defensive rotation. Staying with the risk-off theme, there's a much bigger geopolitical story today. Markets globally sold off sharply as tensions between the US and Iran escalated. Both bonds and stocks tumbled according to Bloomberg's Markets Wrap. Given Japan's unique position as a major energy importer, what's your read on how this affects Japanese markets?
This is a critical story for Japan. Japan imports the vast majority of its energy needs, and a significant portion of that comes from the Middle East, particularly oil and liquefied natural gas. Any escalation in US-Iran tensions raises the risk of supply disruptions in the region, which directly impacts Japan's energy security and can drive up import costs. Beyond the immediate energy angle, this kind of geopolitical shock amplifies global risk aversion, which hits Japanese exporters who are already dealing with fragile demand conditions. So you're layering the geopolitical risk premium on top of existing growth concerns.
And in terms of market implications, how does this layer onto what we were just discussing with copper?
It reinforces the same trade, frankly. On equities, you'd expect continued pressure, especially on cyclical sectors like autos and machinery that depend on stable global trade and supply chains. Energy and shipping stocks might see some mixed action because higher oil prices could benefit them, but the broader market weakness is likely to dominate. The yen should strengthen further as a safe haven currency. Whenever geopolitical risk spikes, investors tend to reduce exposure to emerging markets and rotate into stable currencies like the yen and the Swiss franc. For Japanese government bonds, this is clearly supportive. You get a dual safe haven bid, both from global investors seeking quality and from domestic investors pulling back from risk assets. That should keep 10-year JGB yields under pressure. The one thing to watch is whether sustained energy price increases eventually create inflation concerns, which could complicate the picture down the road.
Right, so in the near term it's a classic flight to safety, but if energy prices stay elevated, that could shift the inflation narrative. We'll definitely need to monitor that. Meanwhile, in corporate news, there's an interesting development involving Mitsubishi UFJ Financial Group. Tudor Investment Corp and its affiliated entities have acquired shares in MUFG, Japan's largest banking group by assets. The report from MarketBeat doesn't give us the exact size of the acquisition, but it's noteworthy given Tudor's profile as a major hedge fund. What do you make of this move?
It's an interesting data point, though admittedly the lack of detail on size and timing limits how much we can read into it. MUFG is a systemically important financial institution and a core holding in both the Nikkei and TOPIX, so any significant change in shareholder composition, particularly from a prominent foreign investor, can signal shifting sentiment toward Japanese financials. One interpretation is that Tudor sees value in Japanese banks as the Bank of Japan continues its policy normalization process. Higher rates are generally positive for bank net interest margins, so if you believe the BOJ is on a path toward further tightening or at least staying away from further easing, Japanese banks become more attractive.
So this could be a bet on the financial sector benefiting from a more normalized rate environment in Japan. How does this translate into market impact?
For equities, it's modestly positive, particularly for the indices given MUFG's heavy weighting. Foreign institutional buying is a signal of demand for Japanese financials, though again, without knowing the acquisition size, it's hard to quantify the impact. If this is part of a broader trend of foreign inflows into Japanese banks, that would be more meaningful. On the yen, there's minimal direct impact. Foreign capital inflows to buy Japanese equities are typically yen supportive because you need to convert currency to make the purchase, but one transaction alone isn't going to move the FX market. And for JGB yields, this is largely irrelevant. Banking sector portfolio adjustments don't directly influence demand for government bonds or rates.
So it's more of a signal about sector sentiment than a market-moving event on its own. Fair enough. Let's pull this all together. We've got copper signaling global growth concerns, geopolitical tensions driving risk-off flows, and a modest positive signal from foreign interest in Japanese financials. How would you summarize the positioning outlook for global investors watching Japan right now?
I think the dominant theme is defensiveness. Between the copper move and the US-Iran tensions, the risk backdrop has clearly deteriorated. For equity investors, that means being selective and likely underweight cyclical exporters while watching for opportunities in defensives or domestic-focused names. For currency investors, the yen is back in its safe haven role, so expect continued appreciation pressure, particularly against higher beta currencies. And for fixed income, JGBs are well supported by both global and domestic safe haven demand. The MUFG story is a reminder that there are still pockets of interest in Japanese assets, particularly financials that benefit from policy normalization, but that's a longer-term structural trade rather than something that changes the near-term risk-off tone.
That's a helpful framework. So near-term caution, but with an eye on structural opportunities as policy evolves. Any final thoughts for our listeners?
Just that days like today underscore the importance of monitoring both global macro drivers and Japan-specific factors. Japan is deeply integrated into global trade and capital flows, so external shocks like commodity weakness or geopolitical risk have real transmission mechanisms into Japanese assets. At the same time, domestic dynamics like BOJ policy and corporate developments like the MUFG acquisition add layers of nuance. Investors need to balance both lenses.
Well said. That's all we have for today's briefing. If you're a global investor tracking Japanese markets or managing Japan exposure, we hope this was useful. Consider subscribing to stay updated on daily market moves and the stories behind them. Thanks for listening to TOITOI Japan Market Radio, and we'll see you next time.